6th. JKL Limited is an Indian company, has an export exposure of JPY. This is 100 lakhs. Okay, 100 lakh means, just a minute, see, 10 lakh is equal to 1 million. These are both in rupees. Okay, 10 lakh is rupee. What I'm doing is just converting from lakhs to millions, and similarly you can also do crores to billions. Okay, and so therefore 100 lakhs would be how much? If we cross multiply, this answer comes to 10 million. Okay, so this is JPY 10 million. Okay, once again the question: JKL, an Indian company, has an export exposure of JPY 10 million receivable in August 31st, 2014. The Japanese yen is not directly quoted against the Indian rupee. You can see this from the spot rates given to you, that Indian rupee quoted against dollar and yen quoted against dollar. So rupee and yen are not directly quoted against each other. Okay, so how do you first of all interpret the quotes that are given? See this. This is a per dollar quote. This is also a per dollar quote. Okay, so $1 is equal to rupee. So I'll write $1 is equal to rupee 62.22, and 1 yen is equal to, sorry, this is also a dollar quote. So $1, because dollar is the standard currency. See, $1 is equal to yen 102.34. Okay, so $1 is equal to, dollar is the standard currency, hence it's a direct dollar quote. So this is $1 is equal to yen means here, right, JPY 102.34. This is how you interpret the quotes and write it down this way, so you get an idea what it is. Okay, then we further get on to the question. It is estimated that the Japanese yen will depreciate to 124, and rupee will depreciate against dollar to 65. Means now JPY becomes 124 and rupee becomes 65 against what? Both against dollar. See, because the spot is the quote that are given to us is a direct dollar quote for rupee and for yen. So this is $1 is equal to 124 yen and $1 is equal to rupee 65. This is what is expected, that is estimated, sorry. These are estimations. Okay, now forward rate, that is if at all you enter into a forward contract in order to hedge your receivables, is it? Yes, receivable, yen receivable. If you enter a forward contract, that particular quotations are rupee upon dollar 66.25 and Japanese yen upon dollar 110.35, that is $1 is equal to yen 110.35. Okay, what is required of you? Calculate the expected loss if hedging is not done, that is if we do not enter into a forward contract. So then what exactly will be the profit or loss? Whatever it is, will be a difference between your spot and the estimated quotes, the estimated rates. Okay, because you are not taking the forward cover. And if the hedging is done, how will the position change if the firm takes a forward cover? If the forward cover is taken, that is if hedging is done, then the difference will be spot and difference between the spot and the forward rate here, this one. Okay, the second question is, we'll come to that later on. First let us solve this particular part. Now see it very clearly, rupee and yen direct quote is not given to you. Okay, yen is not directly quoted against the rupee. Rupee is quoted against dollar, yen is also quoted against dollar. So we have to use both these rates given to us and get a quote which gives us rupee upon yen. Okay, our exposure is yen 10 million. Okay, solution, we directly go to the study material. We are doing from study material because it's already written and solved here, so it saves a lot of our time because we are just revising right now. Since the direct quote for yen and rupee is not available, we calculate this by the cross exchange rates. See, what do we need? What quote we need? We need, see, the yen quote first of all, quoted against rupee, rupee quoted against yen. Okay, because your exposure is 10 million, what? It was yen. So yen, rupee upon yen is what we need. What we have, how do you find this? First of all, we need yen in the denominator here and we need rupee in the numerator here. The other quote, if you see, it is dollar as per the quotes given in the question. Do we have this or not? We'll see this. These two quotes also, do we have this or not? Let's see. The quote given to us in the question, if I'm not wrong, both the quotes were direct dollar quotes. See here, direct dollar quotes. So I know what I'll do. I'll do the split frame so we can get the question and the solution side by side. Yes. See, this is the question. So this is rupee upon dollar is what we have. Okay, and this is yen upon dollar is what we have. What I need rupee upon dollar is something I need. I have that, so I'll take that. Okay, but do I have dollar upon yen? Rupee upon dollar I have. I'll take that. See this one, dollar upon yen I do not have, but I have yen upon dollar. So how do I convert the yen upon dollar into dollar upon yen? Simple inverse quote. Okay, that is 1 upon dollar upon yen is equal to 1 upon yen upon dollar. Okay, simple. So this will be 1 upon 102.34 into 62.22. This comes up to here. This is the answer. Now see, the answer is already calculated here, so we are not going to do this, but if you want to do this, let's see, the answer will be same. 62.22 divided by 102.34, 0.60797 is equal to 0.068. Okay, which is the same here also. See, 0.6080. Okay, are you getting this? This was important here. You use cross rate. We want rupee upon yen. Okay, so yen is in the denominator, rupee is in the numerator. We did that. The missing figures is you take the currency from the quotes available to you. The quote are available to us is here. See the question. If you want me to just remove all the handwriting, I'll do that. See, the quote given to you in the question is rupee upon dollar and yen upon dollar. So the other currency was dollar. So what I did was I took here dollar. The empty spaces were filled by dollar. Now what I have is rupee upon dollar is something that I have, but I don't have dollar upon yen. But what I have again was yen upon dollar. So when you do inverse yen upon dollar, you get inverse of yen upon dollar is nothing but dollar upon yen. Okay, so I did this. 62.22 divided by 102.34 gives me this rounded figure, 0.608. Okay, this was what was important here. So this is how we calculated the spot rate. The spot rate is this. the expected rate is what we have to calculate. We also then calculate the forward rate. Okay, why? Because the difference between spot and expected will give me a loss if in case hedging is not done. Okay, and difference between spot and forward will give me loss in case hedging is done, and then when we compare the both, the loss whichever is less will be beneficial, and if the loss is lower when we take a forward contract, it means that hedging is beneficial and we need to hedge the contract. Okay, this is similarly done. See, estimated year, estimated figures are given to you, 124 and 65. $1 is equal to 65 and $1 is equal to, this is rupee, this is yen, 124. Okay, so we already did this. This would be 124 divided by, sorry, this is 65 divided by 124. Okay, you get the answer 0.5242. This is the expected rate. And then the forward rate also similarly. See, forward rates are given to you. Again the same thing, you already know what the concept, how to do this. Okay, the inverse code, the direct code that I've explained this one time, the same thing is repeating, the numbers are different, that is all. So this will be 66.50 divided by 110.35. okay, when you do that, what is this? This is nothing but rupee upon yen. Okay, now we come to the solution. See, spot, expected and forward, all three of them in the code rupee upon yen we've calculated. Now we can compare them and get the difference. So if calculate the loss without hedging, so value of export at the time of export, that is the spot. See this, multiplied by the exposure yen. Why are we multiplying? Because the code that we have right now is the yen direct code. Yen is in the denominator, direct yen code, and the exposure that we have is also yen. See, 10 million yen. Okay, hence we multiply. See, I'll just show you so you can see how the yen will cancel out. This is the spot rate taken. See this one, multiplied by yen, 10 million. This yen cancels out. Finally you are left with rupee receivable. Okay, this is how you calculate this rupee. This comes to rupee 60,80,000. And similarly, when you do estimated payments received in August 14, now you take the quote of rupee per yen rather, 0.5242, because this is without hedging. Okay, in case you hedge, then you take forward cover. See, forward rate here, this is 0.6 here, 0.6026. In case you've hedged, then the difference will be forward cover and spot, that is 0.6080 and 0.6026. In case it is without hedging, the difference will be spot and what you are estimating will be the rate in August 14. Okay, the difference then is a loss. Okay, because the rate in August will be much lesser, the amount that will be received in rupee in August will be lesser than what is received today. In case you hedge, the amount received will still be less, but if you compare with spot, but if you see, the loss amount is significantly reduced, right? So it is better to hedge. First the loss was coming up to 8,38,000, now the loss is 54,000. So it is important that you hedge. Now So finally the answer they say is, by taking the forward cover, the loss is reduced. There is no profit, but loss is reduced to 54,000. So you hedge, which is if the spot rate on August 31st 2014 are rupee upon dollar 66.25. I'll just write, how do you write this quote quickly? Rupee upon dollar 66.25. okay, this is a dollar, direct dollar quote, direct dollar quote. Okay, then the other one is yen upon dollar, yen per dollar, which is equal to JPY 110.85. so this is yen upon dollar 110.85. okay, again this is a direct dollar quote. Correct. Is the decision to take forward cover justified, is what you have to answer. What we'll do is, in this case, first we will find the rate. See, since Japanese yen is not directly quoted to rupee, rupee is quoted against dollar, yen is quoted against dollar, so we find rupee upon yen is equal to 66.25 into 1 upon 110.85. Why I am doing this? I have already taught this initially, so I am not repeating this again and again. Okay, this, if you see the answer, 66.25 divided by 110.85 comes up to 0.59765. so you can say this is 0.5977. correct. This is your answer. But then what is this? Do not forget to write this again and again. I am saying rupee upon yen. This is your final quote. This you will compare with your spot. What is your spot? See, current spot rates. Rupee upon dollar, yen upon dollar. So again you have to do the same thing. We've already done this, so I'm not doing again calculation. 62.22 upon 102.34. This thing will be equal to rupee upon yen spot. Okay, so we directly go to the solution, because there it's already solved and we directly see from the study material. See the second part here. Actual rate on August 14, 0.5977. This is exactly what we did. Just a minute, I'll show you. See, 0.5977. okay, rupee upon yen. Now we go back. Okay, now value of export at the time of export. This is the spot at the time of export, means when you are establishing a contract, which is the current spot rate, which was this 0.6080. this is common again in all the cases. See, 0.6080, this is the spot rate, 0.6080. okay, this is estimated payment to be received on August 14. This is the actual rate, not estimated. You can cancel this in the right, the actual, because they have given in the question the actual rate on, this is the final rate. Estimated was this one. So actual payment received in August, on August, would be this 0.5977, the rate which we just calculated right now. Okay, and then when you do the difference, you get a loss. Okay, loss is 1,03,000. But if you compare this with the difference between the spot and if you take a forward cover, that is when you hedge, this is when you do not hedge. Okay, by the way, when you do not hedge and the actual rate on 31st August turns out to be 0.5977, what is the estimated loss? Is 1,03,000. But when you do hedge using a forward cover, then what is the payment that you receive is 60,26,000, and hence the loss decreases to 54,000. instead of 1,03,000. So still the loss is lesser, the quantum of loss is lesser, hence the decision to take forward cover is still justified. Okay, now here one more thing is, why is the rate being multiplied to the quantum of 10 million yen? Okay, I've already given the reason for this, but once again we'll do this for just understanding quickly, right? This quote, which is rupee upon yen, which we just calculated, 0.5977 multiplied by, why I am multiplying, because this is a direct yen quote now, a direct yen quote, and the quantum is also yen. What do you mean by the quantum? Which is the exposure. Here in this case is yen, 10 million, yes, 10 million yen. The export receipts, which is the exposure, so yen 10 million. So if you see yen quote and the quantum is also yen, so hence we have to multiply. And when you multiply this, where do we solve this? Here, let's do this again. This quote, rupee upon yen 0.5977 multiplied by yen 10 million. When you do this yen cancels out and you are left with rupee. Okay, this is rupee 59.77, 59 like 77,000. Okay, and rupee. Okay, this is how we do it.